So it's hard for us to understand exactly what was liberated on Wednesday night. That announcement from the Rose Garden was materially worse than even pessimistic predictions had supposed. And today, Steve and I are going to try to discuss what we believe is actually happening behind the scenes with the real game plan, and what does that imply about future potential outcomes, and how should we as investors be positioned in client portfolios. Steve, I'll turn it over to you.
Needless to say, it's fluid, and we're seeing negotiations happen, and where we wind up in a few weeks to a few months will be critical. The longer this drags on of uncertainty, the more we are likely to see slowdown. So the best thing that he/the administration can do for the economy is just provide a level of certainty as soon as they can, and it's something to watch from a time standpoint.
As far as we can gather certainty, let's just talk specifically about what we think the game plan is. I think it's very reasonable to assume that Trump himself doesn't know what the plan is. That may not be fair, but clearly Scott Bessent, Howard Lutnick have a plan. Mm-hmm. These are very thoughtful people, and whether they're right or wrong, or whether we agree with them or not, I promise you there's a plan. Mm-hmm. So can we just articulate very succinctly what do we think that plan is? You mentioned getting interest rates down, and the second component to that plan is what?
Scott Bessent talks about a 3-3-3 plan. One is getting our deficits to GDP down to 3%, currently running at 7%. The second one is 3% GDP growth. And the third one is an increase in 3 million barrels of oil per day, which increases revenue. Lutnick describes it as not in the terms of a title for a novel of a plan, but he talks about cutting $1 trillion of waste, and we can debate whether it's fat or muscle from efforts of DOGE.
There's no way to know.
Yeah, there's no way to know.
They're clearly going to cut some muscle. The question is how much muscle do they end up cutting?
So that's $1 trillion. We're running a $2 trillion deficit. So ideally you cut $1 trillion. The second piece is tariffs. And tariffs can raise anywhere a few hundred billion. Estimates this morning for what he announced were up to $600 or $700 billion. That probably gets dialed back as we have more negotiations. And the final piece, he's out there saying that the U.S. has about $500 trillion of assets, the way he loosely defines them on the balance sheet. That's land, that's mineral reserves, oil and gas reserves, things that he thinks that the U.S. can ultimately get a return on if we, lease drilling rights, whether it's offshore or in Alaska, or sell off buildings that we're not using, or other U.S. broadly defined assets. And he thinks we can get a return on that. So their plan, once again, man plans and sometimes God laughs. The plan is a combination of cutting costs, raising tariffs, and getting incremental revenue from U.S. assets that will allow them to then reduce taxes. They're talking about taking taxes to zero on anybody making under $150,000. At least that's being floated right now. And that's what the plan is. Once again, that sounds great if they can execute on it, but even if they can, that will be bumpy. Getting the tariffs in place, getting manufacturing ramping up in the United States does not happen overnight. This will be a multi-year process. So even if they are successful in their plan, the good stuff happens towards the end of 25 into 26 as we start constructing, onshoring more manufacturing, creating more U.S. jobs that are hopefully higher paying. But they know, and they're out there saying it, that the first part of that plan is taking some short-term pain for long-term gain.
What scares markets, and certainly us, is that it's guaranteed short-term pain, and we're feeling it in the market the last 2 days, in exchange for the potential for long-term gain. And I know that's not a perfectly asymmetric or symmetric analysis, but it is, that's degree of uncertainty is why markets yesterday were down worse than any day since 2020, COVID.
100%. So the gain is less clear, right? So the naysayers are saying this plan has never worked, or tariffs are effectively a tax. And ultimately stagflationary, and there's valid arguments to all of those points. So the naysayers will not give credit for the longer term gain, and then some might give some degree of credit.
Well, the naysayers, myself included, on the tariffs are, we have decades of thought, and I hate to use the word indoctrination, and I'm in this camp, that tariffs are bad. We all studied it. In fact, I would say, look, Republicans and Democrats don't get along, but one of the very few things they agree on historically is tariffs are bad. They used to all agree that price controls are bad, and bad ideas continue to get resurrected from the dead. And the question is, are we actually seeing a very bad idea resurrected from the dead?
I generally agree with you. Tariffs allow businesses to be less competitive on a global basis. So, when the Japanese and Koreans started making better and better cars in the 70s and 80s and 90s and even 2000s, the pushback was clearly to tariff any sort of imports or put trade barriers in, and ultimately many of those companies relocated and co-located facilities in the United States and really North America. They had some supply chain in Mexico and Canada. But tariffs don't make you more competitive. So if you have a hyper-competitive industry and putting up tariffs, it creates this, I would argue, a false sense of security and disincentive to be great. So longer term, I think it's bad for competitive businesses. The flip of that is like, look what happened in COVID. We have outsourced things that we would consider to be critical supply, like making surgical masks or pharmaceutical precursors, military equipment. So there is a balance here that at least I'm sympathetic to, where we for our own national security, safety, independence, want to make sure that we have capability to do a degree of our own manufacturing internally.
So I have two thoughts. We have Bessent and Lutnick coming up with what one would assume is some strategic chess move. And look, perhaps, because my counter to this is, why don't we negotiate where tariffs are unfavorably balanced from our perspective? Why can't these be surgical negotiations, which I presume they've always been? And why can't Trump just be tougher on any of these one-off negotiations? Why do we have to go blanket globally? And I don't understand the reasoning. Perhaps there's this view that it's effectively, we're now subject to this non-US cartel, and we have to break the cartel and effectively blow it up, start from scratch. Maybe it's all just a bluff. And this is what scares me the most, is what if what we saw yesterday is actually not Bessent and Lutnick's plan?
What we saw Wednesday was bigger and bolder than anyone was expecting. If you were, from my opinion is, if you were rationally putting tariffs in place, what you would do is you would say, in 2025, the tariff starts at a really small number. In 26, it ramps up to 10%. In 27, it's 15%. In 28, it's 20% or 30% or whatever it needs to be, that gives companies time and incentive to plan, rejigger their supply chains and move forward. So then the question is, like, why would they do it in a way where no one can respond, right? So here we're speculating. Maybe you force someone to a table to say, okay, I'm going to go and commit to building something in America or redoing it, and this is how you get them to the table when they might not have beforehand. Historically, when Trump, at least Trump 1.0, when they moved slower, you had Washington lobbyists, corporate lobbyists, work behind the scenes through their congressmen, senators, other soft power to water down some of the things that they wanted to do. And I'm not trying to defend this, I'm not trying to say this is right. Maybe they felt they had no choice but to make this big, bold splash move in order to not be carved into 1,000 little pieces by the powers that be behind the scenes. Regardless, we have what we have. They went big and bold. It's causing chaos. We're seeing it in markets. We're seeing it in we're seeing it in uncertainty to make capital expenditures, and we can only hope this calms down over the next days and weeks.
So Steve, I actually read this morning a quote from Jim Grant of Grant's Interest Rate Observer that tariffs spell trouble. Trouble means opportunity. God bless Jim Grant. So where the hell is the opportunity in all this madness?
There's definitely opportunity. Let's start with the reshoring, onshoring. Reshoring means a CapEx boom, we think not only in the United States, but also globally. US, we're going to rebuild our own supply chains and our military capabilities. We're seeing tech investment and semiconductor investment in Arizona and Ohio. We're seeing companies like Anduril spending billions of dollars as well, which are lower cost drones and missiles. Honda is going to build the new Civic in Indiana versus Mexico, and on and on and on. And Trump will tout, I think, $5 to $6 trillion of commitments now to invest in the United States. What that actually is well, it's definitely a lower number, but that's where we are now, and that's what they're trying to do. But it's not just a US thing, it's also international. So if you were Europe relying on the United States for defense, you're now thinking long and hard about having to build up your own military supply chain to defend yourselves. So we're seeing announcements out of Germany talking about $500 billion to $1 trillion of defense spending. France is following suit. The UK is following suit. So barring a global recession, we are seeing what appears to be it's all signs to increasing CapEx both domestically and internationally, which means more activity, more needs for energy, more needs for manufacturing and all the commodities that go into that. Separately, tariffs are just by definition inflationary. The reason why we outsourced manufacturing to Asia or clothing to Bangladesh was because it was cheaper to do it. If you bring it back, guess what happens? It's not as cheap to do it. So that is technically inflationary. I don't think there's any way around that. Granted, we have more robotics and automation that will help soften that, and we'll see where that ultimately goes over the next 3 to 5 years. But at least in the near to intermediate term, it's inflationary. So
you can't print more people. We can print money. You can't print people.
Nope. And the hope is you can print robots in 5 to 10 years, but not people. And that's the key point. So that's inflationary. And we're seeing, especially with the announcements being made, central banks are buying more gold. It's positive for gold. It's positive for silver with respect to energy production, and silver is used in solar panels and electronics, and we ultimately think it's positive for a number of select commodities.
I mean, in fact, this is a trend that we were already exposed to because this reshoring was already underway for multiple reasons, but it was really sparked by COVID when we woke up and were like, hey, we shouldn't be making all the masks overseas. And then Ukraine accelerated it further. In fact, let's take a look at this chart. You can see here the growth in the investment in U.S. manufacturing infrastructure. I mean, this is a dramatic pickup, and to emphasize, that's just to today. We've seen this trend in place. So we've already been exposed, thankfully, pretty heavily in the typical client account already, and it's been good so far. We think going forward, I mean, this is not a 1 or 2 year theme.
No, it took 40 years to outsource our supply chain to just in time. This will not take 1 year or 2 years to come back. And how far we come back, that's a conversation for another day. This started under really the Biden administration in 21-22, and we think it's likely to accelerate under the current administration.
You know, I've always been, I think we're all becoming a little numb to the just repeated use of robotics and automation in everything we read. It's been a little overhyped and a little slower to come. Although if you see the Boston Dynamics robots videos on Instagram or whatever you look at, it's amazing. But I will tell you, I was in Phoenix for a conference a couple of weeks ago, and I did my first Waymo taxi. You've done one, right?
Yeah, they're great.
You know, so when I will tell you, it is absolutely. I felt safer. It was cleaner. It was faster. and obviously heavily subsidized, thank you Google, very cheap. And it just hit me, like this robotics thing is actually, we're ready for it faster than I think I intrinsically understood. So the win-win here is, historically we had to go to China because the labor was cheaper. The more we can automate, the less the low-cost labor advantage works against us, and we're able to, in fact, if you can make stuff here with robotics, you're actually closer to the end customer. So while the next couple of years could be super bumpy, if we end up making more stuff here with robotics, that's going to be a huge CapEx boom, which we're already positioned for in client portfolios. And that has been a good buffer so far against the madness. We've already been exposed. Why don't we talk about international? What does this mean for international stocks? Everyone's so down and out on Europe. It's been sluggish growth, very cheap stocks. Could this end up being the kick in the pants to innovate and effectively modernize? Could this be a 1980-82 moment for Europe?
If it isn't, Europe has a problem. So we're going to go with it is the spark to innovate and move European companies and countries in a forward direction that's ultimately positive for themselves and then the profitability of those entities. So we are seeing capital come out of the United States and flow into Europe from a flow standpoint. That's pretty clear and obvious. And whether, given everything that's going on with reorienting supply chains, this will be positive for economic activity in Europe as well.
And it's already showing itself in international markets. International indices are, flat for the year?
They're flat.
Before Wednesday's announcement, international markets were up roughly high single digits, and I think EM was actually, emerging markets were up even more, while the S&P was actually down for the year. So it feels good because I will tell you, we've had international equity typically in the range of 45% of our equity exposure as a kind of a model target, as much as practical, depending on the client's legacy positions. We've tried to get clients towards that. And I will tell you, since 2015, it's underperformed US. Finally, I think we could be at the point where we actually see international outperform domestic potentially on a go-forward basis, which, if you go back far enough, international markets have outperformed U.S. markets going back decades. Again, not since really 2008.
The interest rates matter a lot to certain sectors in the United States. I was on the phone with one of our private real estate investments yesterday, and for the first time in 2.5 years, the banks are opening up, rates are down, activity is starting to percolate, and they are now breaking ground on a couple projects now because of the supply slowly being absorbed. There's no longer new supply of at least multifamily housing in certain markets, and we're seeing activity reoccur. And part of the accelerant there is a lower rate environment. So if rates do come down a little bit more, that actually also bodes well for positive economic activity. And there's a long way to fall, even if the economy slows, where rates could offer at least some sort of ballast and support for economic activity if things do get choppier in the near term.
And the other thing helping international is a weaker dollar.
Yes.
To what degree do you think a weaker dollar is part of the Besant-Lutnick plan?
It's center. It's front and center. They don't talk about it outwardly because every Treasury Secretary has always said the U.S. dollar policy is always a strong dollar policy. We need people to buy our treasuries. In Trump 1.0, the U.S. dollar did weaken. Trump is out there saying other countries are artificially manipulating their currencies lower to export more. Their costs are in a currency that's weaker. They can export more to the United States, and he feels that they benefit versus us benefiting. I think it's part of the plan. It has to be part of the plan to ultimately improve our manufacturing competitiveness around the world. And Here's the point we haven't talked about, and I don't think we've even written about. When you look at Trump's voters, most of them aren't stock owners. They're more Main Street versus Wall Street. If you want to put your political hat on, he wants to make the environment for jobs and income better. Even if there's inflation, if there are jobs that are even supervising the robots or fixing the robots or doing things that are higher value add than, let's say, retail or type of jobs, that's would be viewed as a win for the administration. So with a weaker dollar, also inflationary, right? Weaker dollar, other stuff costs more. You can also have wage inflation. So I think that's part of the calculus. It's my opinion. It's not strongly held, but it is my opinion that a weaker dollar, stronger wage inflation benefits his base and his voters, benefits the U.S. worker. Inflation actually ultimately helps a bit with the debt as well. So I do think it's part of the calculus. So when you see the dollar falling, they don't want it to crash or collapse, but you don't see them defending the dollar weakening when it's falling. And it has been falling from the beginning of the year, and interest rates have been falling from the beginning of the year. So on those two fronts, they're getting what they want. They're getting a lot of chaos in the interim, but on those two fronts, they're getting what they want.
And especially comparing international equities as a class to market cap weighted Mag 7 U.S. equity indices, the international markets are, we believe, growing at the same or better in terms of growth and earnings, and they're substantially cheaper, both in absolute terms and in relative terms to where they've been in history, which historically, based on past studies of markets, bodes well for higher potential returns in those markets, which is why we've been as heavy as we've been in international equities broadly. We do think, however, that active management, unlike in large liquid markets like the US, active management is a must in most international markets, which is why we use active managers there. So going back to what we believe works in this world order, what else do we like?
If we believe near term it's a little stagflationary, that playbook would be commodities, gold, inflation protected securities. Generally real estate should do okay. To your point, you mentioned international equities, and check. We own all that for clients. There's also some selected private assets that may or may not be less correlated to either GDP or economic activity, and I think some of those are also interesting in this environment or other environments. And then finally, we're going to be adding some trend following strategies, which historically generally perform as well as markets over long periods of time, but can be uncorrelated to actual stock markets. So if rates trend down for a while, these trend following strategies will be short rates, or if markets are going down, they'll be short markets, or if rates are going up, they'll be long rates, or markets going up, they'll be long markets, and they'll do things as esoteric as coffee beans or other things. So we'll be adding some of that stuff to client portfolios.
And one thing that I think worth noting on trend strategies do really, really well when there's a long trend up or a long trend down. Where trend strategies are challenged and are mediocre to bad performers is when you're in a long market of sideways, which has actually kind of been where we've been in this financial repression regime since 2008. If we are in a 1980 to 1982 moment where we are genuinely at an inflection point, whether it is positive after 1982, where we actually saw real economic growth with low inflation, or heaven forbid, where it's an inflection point as we, depending on where you want to start, 65 to 72 to 73 to 74, where we saw just the opposite, higher than expected inflation and lower than expected growth, which is stagflation. I believe trend would be ideally suited for either of those worlds.
Should be, but we do believe that it's a positive expected return with correlation that's often negative to global markets, which is really powerful from a portfolio construction standpoint, because you can be, when trend is up a lot, sometimes markets are down, you can be selling trend and buying stocks that are more cheap, more attractive, or vice versa. So I think that's interesting.
Manager selection there is key.
Very key.
All trend is not the same.
It's true.
And to close the loop on what we like, I would just add to that T-bills are not horrible.
T-bills at current rates provide optionality, and they pay. So they're beyond not horrible. They're actually pretty good in an environment of fear. We are avoiding long-term treasuries because it's just less clear to us whether they're going to be able to really take out the long end or get it down further, given the amount of debts and deficits they have. It's just a bet we don't want to make. We just don't want to make the duration.
Bet is the right word. If interest rates, heaven forbid, if we were to go through a 1970s type of bond vigilante, interest rates do spike up because of inflation and fear. Long-term treasuries, remember, long-term treasuries were down over 20% in 2022. Yeah. So we're avoiding that. Anything else that we should put on the avoiding list? We've already talked about market cap weighted Mag 7, tilting away from that, not necessarily avoiding, but tilting away from the Mag 7.
The other thing is, at least where credit spreads were as of a few days ago, credit spreads are the amount you're paid on top to take risk on top of treasuries. So if you're buying a corporate bond, is that risky? If you're buying a bond that's corporate but quote unquote high yield, ranked by the credit agencies, they were as tight as they've almost ever been. So we felt that you were getting almost no reward for the incremental risk you were taking. As of this recording, they're starting to widen out a little bit today. One thing I want to highlight is every cycle is different. You and I have lived through a few. We talk to and respect people that live through more than a few.
You and I have lived through more than a few.
We've lived through more than a few, but I want to note, at least as of this morning, measures of fear are as high as we've seen since COVID from a sentiment standpoint.
And that's quantified.
Yes, and it's quantified as follows. So we're seeing the VIX, which is the volatility index, over 40. That generally means times of extreme crisis and fear. The bull-bear ratio of newsletters is basically back to full levels of fear. Believe it or not, CNN puts out a fear and greed index that goes anywhere between 0 and 100. That was at 4 this morning. Last time we were down there, also COVID. There is palpable fear there now, and even though markets are not down 25 or 30 or plus %, generally what happens when those fear levels are that high, the sentiment is back to that level. So even if we're ultimately going to go down that much, and that is not our base case at all, you never go down in a straight line. So the sentiment is all lined up on one side. You have $7 trillion sitting in money markets. Hedge funds have de-risked, quantified. We are at this level of where everyone is got much more fear and are scared versus greedy and excited. And just note that generally marks at least interim support levels. Not that we're technical analysts, but we note it when it gets this extreme.
Yeah, or translated, market could still go down a lot more. Markets always tend to go wherever they can do the most damage, and that's where they're going right now. The question is, where do we see support? I will reemphasize that unlike COVID, well, let's define what's like COVID. What's like COVID is that there's no playbook. I hear people talk about the 1920s, 1930s. I think that's a bad playbook. We believe no playbook to what's happening right now. Same as we felt in COVID. One difference. In COVID, it was external. Today, this is a self-inflicted policy decision, which means that at least Trump could get on a microphone this afternoon and send the stock market back up. He's not going to do it. but the fact that there is the ability to cry uncle, or thankfully we live in a system that self-corrects. We may have to wait a year to the midterm elections, or to, heaven forbid, out 4 years if this is not working, for the system to self-correct. And of course, if he's right and this bet pays off, then he'll look like a genius. But it is certainly safe from a planning perspective to not assume either. But I do think it is important to remember the future is a probability tree, and we have to recognize there are multiple branches as to how this could play out. The important thing is to stay diversified so that we own assets that we believe across a long cycle will outperform on a fundamental basis, but that we have a mix of the assets such that the portfolio can breathe and evolve and adapt regardless of which direction this plays out. And I do believe that our mix of, on the fixed income side, treasuries, tips, private credit, at least while spreads remain wide, relatively wide there, and on the equity side, heavy mix of international equities, which we've had for quite a while and are glad to have those today. And lastly, to have the ability to be truly flexible in alternative and private assets, because if the world gets really weird and crazy, we're going to have to be hunting in alternative in private markets for assets that are offering better potential returns than available in public equity markets.
I agree.
What else can we talk about that people aren't already watching on TV? That's the one thing we don't want to do, is be too repetitive on.
Here's think about it this way. So Trump 1.0, he had the Dow Jones Industrial on his phone that he probably checked every hour. Every day he would judge himself by the market. Now all of a sudden he doesn't care. I find it hard to believe that he's changed that much. He cares. He may not just be talking about it yet. To your point on what is different this go around of uncertainty versus prior goes around of uncertainty, and it's always different. The administration is trying to reorder and redirect a course that they thought would ultimately lead to disaster and crisis, meaning too much debt, too much deficits. They are attempting to do what we did not think that someone would try, which is a form of austerity and cut waste, fraud, and abuse, reorder the global manufacturing dynamic. That is a choice that they're making, and that is the current game plan. If it doesn't work, or if the politicians who all do look at polls and popularity and what is supported and does not, if at some point it does not work, either they're going to get voted out of office, or two, they're going to course correct, and then it goes back to print and inflate. And they can choose that. So that is not external, that is an internal choice. You and I are not predicting that that's going to happen, but just know that it is a branch on the probability tree.
Not a small one.
Not a small one, that's fair. So remain nimble.
I don't think you can close on any better comment than nimble. I like that word. Adaptable. Nimble's, it's cuter. It's a better word. So with that, we'll wrap up.